Hello everyone. Welcome to a short lesson video on the topic Standard Costing for Cambridge A-Level Accounting. In this video, we will solve a recent past paper question involving a mix of material, labor, fixed overhead and sales variances. But before we proceed, please note abbreviations are used in this presentation only due to space constraints. Abbreviations are strictly not allowed in the Cambridge exams. With this in mind, let's get started. So this is a March 2022 paper variant 3-2 question. So Y Limited produces one product and budgeted units produced and sold for the month of July were 1000. Then we have been given the sales, the direct material, direct labor, fixed overhead and profit as per the budget. We have been told that fixed overhead is to be absorbed on the basis of direct labor hours. The actual units produced and sold for July were 1120. In part A, we have to prepare the flexible budget to show the budgeted profit for the month of July. So this is part A, flexible budget for July. We have already been given the format for the budget, so we'll prepare our flexible budget on similar lines. That means in the details section, we will have the sales minus direct material minus direct labor minus fixed overhead, and then in the last row, we will have the flexible budget profit. Now, flexible budget sales is actual quantity of sales multiplied by the budgeted selling price per unit. Actual sales we have already seen were 1120 units. So, in the brackets, we'll write 1120 units multiplied by the budgeted selling price per unit. Now, we don't know the budgeted selling price per unit, so let's prepare a working note for that. So, this is working note 1, budgeted selling price per unit is equal to total budgeted sales upon budgeted units. We know that budgeted sales were 250,000 and budgeted units were 1000. So this is $250,000 upon 1000 units. Therefore, the budgeted selling price per unit is $250. So we will write $250 here, which we have derived from working note 1. So 1120 multiplied by $250 will give us $280,000. Next, the flexible budget direct material cost will be the number of units actually produced multiplied by the budgeted direct material cost per unit. We know that actual units produced and sold for July were 1120. So in brackets, we'll write 1120 units multiplied by the budgeted direct material cost per unit. But we don't know this, so we have to prepare a working note. Working note 2, budgeted direct material cost per unit is equal to total budgeted direct material cost upon budgeted units. Budgeted direct material cost was $60,000 and budgeted units were 1000. So this is $60,000 upon 1000 units. Therefore, budgeted direct material cost per unit is $60. So in our main answer, we'll write 60 and give the reference of working note 2. Therefore, in the flexible budget for July, the direct material cost amounts to $67,200. Next, we find out the direct labor cost in the flexible budget for July, which is actual number of units multiplied by budgeted labor cost per unit. We know that actual units were 1120. So in our main answer, we open the bracket and write 1120. But to find out the budgeted direct labor cost per unit, we will have to prepare a working note. Working note 3, budgeted direct labor cost per unit is equal to total budgeted direct labor cost divided by budgeted units. Budgeted direct labor cost was $100,000 and budgeted units were 1000. So in our working note 3, we'll write $100,000 divided by 1000 units. Therefore, we get budgeted direct labor cost per unit is $100. In our main answer, in the row for direct labor, we will write $100 and give the reference of working note 3. Therefore, the direct labor cost in the flexible budget for July will be $112,000. Next, we must find out the fixed overhead expenditure as per the flexible budget, which is actual number of units multiplied by budgeted fixed overhead expenditure per unit. Actual units we have already seen were 1120. So in the row for fixed overhead, we will open the bracket and write 1120 multiplied by budgeted fixed overhead rate per unit, for which we will have to prepare a working note. But before we prepare our working note, we must bear in mind that fixed overheads are to be absorbed on the basis of direct labor hours. So this is working note 4. Budgeted fixed overhead per unit is equal to budgeted labor hours per unit multiplied by budgeted fixed overhead rate per hour. In our formula, we have considered budgeted labor hours per unit, and this is because fixed overheads are absorbed on the basis of direct labor hours. If fixed overheads were absorbed on the basis of direct machine hours, then this would be budgeted machine hours per unit. We don't know this figure, so let's calculate it. Budgeted labor hours per unit is equal to total budgeted labor hours upon budgeted units. But again, we don't know the total budgeted labor hours. So we'll have to calculate it. I'm going to start this calculation on a fresh slide, but in the same working note. You can prepare a separate working note if you wish. Budgeted number of labor hours is equal to total budgeted direct labor cost upon budgeted direct labor rate per hour. Total budgeted direct labor cost is $100,000 and the budgeted direct labor rate per hour is 25. Putting these values in the formula, we get $100,000 divided by 25 and we get the budgeted number of labor hours, which are 4,000 hours. Now we can use this figure to find out the budgeted labor hours per unit. Total budgeted labor hours we have just seen are 4,000 divided by budgeted units will give us the budgeted labor hours per unit. We already know that the budgeted units are 1,000 and that figure will be our denominator. So 4,000 hours divided by 1,000 units will give us 4 direct labor hours per unit. These are the budgeted labor hours per unit. In our formula for budgeted fixed overhead rate per unit, the first term is budgeted labor hours per unit and we have just found that out. It is 4 hours multiplied by budgeted fixed overhead rate per hour, which we still need to find out. Budgeted fixed overhead rate per hour is equal to total budgeted fixed overheads upon total budgeted labor hours. Because remember, fixed overheads are absorbed on the basis of labor hours. Budgeted fixed overhead is $24,000. So budgeted fixed overhead rate per hour is $24,000 divided by budgeted number of labor hours, which is 4,000. We have already found that out. Therefore, the budgeted fixed overhead rate per hour is $6. Now that we have found out the budgeted fixed overhead rate per hour, we can use it to find the budgeted fixed overhead per unit. So this is $6 we have just found out. Therefore, 4 hours into $6 per hour. Our budgeted fixed overhead rate per unit is $24. With that, we have completed working note 4. So we can use this value to find out our answer in part A. Our fixed overhead cost is 1120 units multiplied by $24 per unit, which we have calculated in working note 4. So our fixed overhead in our flexible budget is $26,880. Now we can find out the flexible budget profit for the month of July. 280,000 minus 67,200 minus 112,000 minus 26,880. which gives us $73,920. With that, we have completed part A. In the next part of the question, we are given actual results for the month of July, and then we are told that a variance analysis is going to be conducted. And so, in part B, we have to calculate some variances. The first one is sales price variance. So, let's compute that. So, this is part B, subpart 1. Sales price variance is equal to standard selling price minus the actual selling price, the whole thing multiplied by the actual quantity sold. In working note 1, we have already calculated that the standard selling price is $250 per unit. Therefore, sales price variance is equal to 250 minus the actual selling price, which we don't know. So let's prepare a working note to calculate it. This is working note 5. Actual selling price is equal to actual sales upon actual quantity sold. The question says that the actual sales were $277,760 and the actual units sold were 1,120. So the actual selling price is $277,760 upon 1,120 units, which gives us $248 per unit. Putting this value in a formula for sales price variance, we get sales price variance is equal to $250 minus $248. We'll give the reference of working note 5, the whole thing multiplied by the actual quantity, which is 1120 units we have already seen in the question. So multiplying by 1120, we get sales price variance is equal to $2,240. Now let's check whether this variance is an adverse variance or a favorable one. The company had estimated that it would be able to sell its goods for $250 per unit, but actually it was able to sell its goods only for $248 per unit, that is at a lower selling price. Therefore, this is not a good thing for the company, and so this $2,240 is an adverse variance which will be denoted by the letter A in brackets. In part B2, we are required to find out the sales volume variance. Part B2, sales volume variance is equal to standard quantity of units minus actual quantity of units, the whole thing multiplied by the standard selling price. Standard quantity is 1000 units and actual quantity is 1120 units. So putting these values in the formula, 1000 minus 1120 multiplied by the standard selling price, which we have already found in working note 1. In working note 1, we saw that the standard selling price was $250 per unit. So we'll write 250 over here in the equation. Solving this further, we get standard volume variance is $30,000. But again, is this a favorable or adverse variance? The company had estimated that it would be able to sell 1000 units, but actually it was able to sell 1120 units. That means it was able to sell more units than estimated, which is a good thing for the company, and therefore this $30,000 is a favorable variance, which will be denoted by the letter F in brackets. Part B3 requires us to calculate the direct material total variance. So this is part B3. Total direct material variance is equal to flexible budget direct material cost minus actual direct material cost. I have explained this formula in detail in my material and labor variances video. While solving part A of this question, we had found that the flexible budget direct material cost was $67,200. So we will use this figure in our formula. So this is $67,200 minus the actual direct material cost. The actual direct material cost has already been given to us. It is $72,688. Putting this value in our equation, we get total direct material variance is $5,488. But is this variance favorable or adverse? The company had estimated that the flexible budget direct material cost would be $67,200, but the actual direct material cost is $72,688, which means that the cost is higher than estimated. And therefore, this $5,488 is an adverse variance which will be shown by the letter A in brackets. In part B4, we find the direct labor total variance. So we'll write the formula. Direct labor total variance is equal to flexible budget direct labor cost minus actual direct labor cost. I have already discussed this formula in my material and labor variances video. Previously, in part A of our answer, we have found the flexible budget direct labor cost. It is 112,000. So we'll write 112,000 in our answer minus the actual direct labor cost, which is already given to us in the question. The actual direct labor cost is $128,520. So this is $128,520. Solving this further, we get $16,520. As to whether this variance is favorable or adverse, we see that as per the company's flexible budget, the direct labor cost was estimated to be $112,000, but in fact, it was $128,520. The actual cost is higher than the budgeted cost, and therefore, this is not a good thing for the company, and it is an adverse variance which is denoted by the letter A in brackets. In part B5, we have to find the fixed overhead total variance. So this is part B5. Total fixed overhead variance is equal to flexible budget fixed overhead minus actual fixed overhead. I have discussed this formula in detail in my fixed overhead variances video. In part A of the answer, we have already calculated the flexible budget fixed overhead, which is $26,880. Using this value in the formula, we have $26,880 minus the actual fixed overhead which is given to us in the question. Actual fixed overhead is $25,600. So we'll write 25,600 here, which gives us $1,280 of variance. Now let's see whether this variance is adverse or favorable. As per the flexible budget, the fixed overhead cost was to be $26,880, whereas actually it was $25,600. So the actual cost was less than the estimated cost, and therefore this variance is a favorable variance because this is a good thing for the company. In the last part of the question, we are given some additional information which states that the directors are interested in further analysis of the variances in direct materials. And so in part C of the question, we have to calculate the two variances which combine to give the direct material total variance. In the video on material and labor variances, I have discussed that the direct material total variance is made up of two variances. One is the direct material usage variance and the other one is the direct material price variance. So we will have to find out each of these variances to answer the question in part C. So first we'll find direct material price variance. This is part D. Direct material price variance is equal to standard price of material minus actual price of material, the whole thing multiplied by the actual quantity of material. Now standard price of material is $12 per kilo and the actual price of material is $11.8 per kilo. So this is 12 minus 11.8, the whole multiplied by the actual quantity of material. Now we don't know the actual quantity of material consumed. So we'll have to prepare a working note for that. This is working note 6. We have to find the actual quantity in kilos. The formula for which is actual quantity of material in kilos is equal to actual direct material cost upon actual price per kilo. Actual direct material cost is given to us. It is $72,688. So this is $72,688 upon actual price per kilo. We have been given the actual price per kilo in the question. It is $11.8. So we'll write 11.8 in the denominator. Finally, we get the actual quantity in kilos, which is 6,160 kgs. So we'll put this value in our formula and also give a reference to the working note. Solving this further, we get $1,232. The company had estimated that it would buy material at $12 per kilo, but actually it bought material for a lower price, that is $11.8 per kilo, which is a good thing for the company. And so this $1,232 is a favorable variance, which is denoted by the letter F. Lastly, we have to find the direct material usage variance, the formula for which is standard quantity of material for actual output minus actual quantity of material used multiplied by the standard price of material. Now, before we find the standard quantity of material for actual output, we need to find the standard quantity of material for standard output. That is the budgeted standard quantity of material. So we'll prepare a working note 7. Budgeted standard quantity of material is equal to total budgeted direct material cost upon standard price of direct material, which is equal to standard material cost is 60,000 and standard material cost per kilo is 12. Therefore, this equation becomes $60,000 upon $12 per kilo, which gives us 5,000 kilos of direct material. Now, this is the budgeted standard quantity of direct material or the standard quantity for standard output. Now, please pay close attention to the following calculation. So, we have one column called kgs and another one called units. 5,000 kgs of direct material, which we have just derived here, is required for budgeted output of 1000 units. So we'll write 1000 here. 5000 kgs of direct material are required for 1000 units of final product. So how many kgs are required for actual units, which are 1120? So we'll write 1120 here. So we will cross multiply. This is 5000 into 1120 divided by 1000, which comes to 5600 kgs. This is the standard quantity for actual output of 1120 units. So putting this value in the equation, we get 5600 minus the actual quantity of direct material, which we have already derived in working note 6. Actual quantity of direct material is 6160 multiplied by the standard price of direct material, which is $12 per kilo as per the question. So we'll write 12 here. Solving this further, we get $6,720. Now, the company had estimated that 5,600 kilos of material would be consumed, but actually 6,160 kilos of material were consumed. So, more material was consumed, which is not a good thing for the company, and therefore, this is an adverse variance denoted by the letter A in brackets. With this, we have completed part C of the question, and that means we have completed the entire question. So this was a recent past paper question on standard costing. In the next video, we will learn about reconciliation of variances.